If buying a home already feels impossible, a 50-year mortgage isn't the lifeline it sounds like. It is a long-term trap disguised as affordability. The Trump administration has unveiled one of its most talked about housing ideas yet, the 50-year mortgage. It is being framed as a bold solution to America's housing affordability crisis, a way to make the dream of homeownership more attainable by stretching payments over a longer period. But while the idea may sound appealing at first glance, the numbers tell a much more complicated story. Here's the pitch. If you can spread your mortgage payments across 50 years instead of 30, your monthly bill goes down. For millions of Americans struggling with high home prices, that could make the difference between renting forever and finally owning a home, owning on paper, because if you don't have equity, you don't own it. Your bank does. And here's the problem. The math of a 50-year loan doesn't actually change the fundamental math of borrowing. It just stretches it out. And it makes you pay more in interest to corporations rather than allowing you to build equity in your home. In other words, when you stretch mortgage payments from 30 years to 50 years, the cost of borrowing skyrockets. It's not in your favor. Let me show you the numbers. Say you take out a $400,000 mortgage on a $500,000 home. That is after putting down the usual 20%. If you lock in a 30-year fixed rate, let's say at 6.25%, your principal and interest payment is about $2,463 per month. Now let's extend that same loan to 50 years. Your payment drops roughly to $2,180 per month. That is a monthly decrease in mortgage payments of $283. This is not a saving because all you're doing here is postponing paying that amount, but now you've got to pay compounded interest on these $283 too. And of course, that monthly relief comes with a massive long-term cost. Over the life of the 30-year mortgage, you would pay about $487,000 in interest, but over 50 years, you will pay $908,000. That is more than $421,000 extra, nearly doubling your total interest payments. The small monthly savings, quote-unquote, pale next to that long-term financial burden. So simply speaking, without considering time value of money and other financial details, for a $500,000 home, you will end up paying $908,000, twice the cost of what it was worth on day one. And it's not just about paying more, it is about how slowly you build equity. That's the real problem too. With a traditional 30-year mortgage, you're building ownership from the start, from day one. After 5 years, for example, under traditional terms, you might have paid off over $30,000 in principal. With a 50-year mortgage, that same borrower would have paid off just around $6,000. After 30 years, the point when a 30-year mortgage would be completely paid off, you would still owe nearly $400,000. Very slow equity growth is the hidden danger. You will owe nothing, and arguably you still won't be happy because you don't own your home and you're liable for hundreds of thousands of dollars. For most homeowners, equity is their largest form of wealth. It's what allows you to upgrade, to refinance, or to retire comfortably. A 50-year mortgage turns that process into a crawl. It's almost like renting from the bank for half a century. And on top of that, there are significant risks. If home prices stagnate or fall, borrowers could find themselves underwater, owing more than their homes are worth for years and years. That's what happened during the 2008 financial crisis when complex, long-term or interest-only mortgages left millions trapped. Studies show that longer loan terms could raise the risk of default by 150% to 200% when property values decline. There is another issue too that I would like you to be aware of. Affordability through debt doesn't solve the real problem. The real problem that nobody wants to talk about is supply. If millions of new buyers suddenly qualify for a mortgage because monthly payments are lower, but the number of homes for sale doesn't increase, prices will rise, they will surge. And we could end up in a vicious cycle where extending loan terms makes homes more expensive overall, not less. So it's going to make the affordability crisis so much worse. And lenders are fully aware of this. They will likely charge slightly higher interest rates for such long-term products, maybe 0.5% or even a full percentage point more, to compensate for the additional risk. In finance, higher risk requires higher reward, meaning higher interest rates in this particular instance. And that further erodes whatever monthly savings borrowers gain from this. So to sum it up, homeowners could end up paying hundreds of thousands more in interest. They will build equity painfully slowly, leaving them more vulnerable to downturns. And if this triggers a new wave of speculative buying, home prices could rise further, erasing the very affordability gains this policy aims to deliver. Critics say it is a short-term fix to a long-term problem, addressing symptoms, not causes. And the truth is, the housing affordability crisis isn't just about financing. It is about a chronic shortage of supply, restrictive zoning laws, and the cost of construction. Without addressing those issues, extending the mortgage term could just inflate the bubble. There's also a generational angle here too. Imagine being 80 years old and still making mortgage payments. That's a very real possibility with a 50-year term, especially if you buy in your 30s or your 40s. Homeownership has traditionally been a pathway to financial security and retirement. This plan could delay or even deny that security. Stretching debt longer doesn't make it smaller, it just hides the cost further down the road. Until the housing supply meets demand, stretching loans from 30 to 50 years is like stretching a dollar bill. It may look longer, sure, but it's still worth the same amount. The 50-year mortgage may be designed to reshape the housing conversation, but unless it's paired with real solutions to housing supply, it risks becoming less of a dream and more of a debt trap, one that lasts a lifetime. Thank you so much for watching. I hope that you enjoyed this quick video, and if you would like more content, join me on Substack and Patreon, support my work. I appreciate every single one of you who has become a paid subscriber. Thank you so much. Like, subscribe, and share, and I will see you back here tomorrow. Take care.